Welcome everyone to Vested Interest. This is Shane back for another stock pick of the day video. It is August 14th, almost halfway through the month already. We are going to take a look at one we have looked at recently. Selfishly, this one is actually for me. Starbucks is the one we're going to look at, and it has had a big rise yesterday, but then a bit of a dip today. So we're going to take a look at it and see, with the little bit of the roller coaster it's been on over the last couple of days, if this one still fits the criteria we're looking for, or if we should potentially look to be trimming this position, even though it's one we recently started in the portfolio. So let's jump into the video. And Starbucks is out of the consumer discretionary sector. Before we get too far into the video, if you could do me a big favor, hit that thumbs up button down below. If you find any value in this content, is Starbucks in your portfolio? Make sure you are subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Hit that subscribe button down below and ring that notification bell. Make sure you click that notification bell so you're notified whenever we put out any new content. We do the stock pick of the day videos this series Monday through Thursday. When the market's open, we take a look at a stock that's pulled back on the day and see if it is presenting any value. We run through the screener and then take a look at some of the fundamentals and see if it will make it onto my watch list. This is actually going to be a review of one that isn't on my portfolio already because I use the screener in a similar manner. Really appreciate all the subscribers out there who have subscribed to the channel. The channel continues to grow because of people like you. This is the Vested Interest stock screener. This is how I look at the companies that we're going to review. This is the criteria we're going to run through in this video today. It's also how, like I said, this one is in my portfolio, so I'm going to look at it and see if it still meets some of the initial screener criteria here, or like I said, if it maybe is, now that it's had a big run up and a bit of a little pullback, is it one that we should be worried about in the portfolio? All right, back to Starbucks. Let's check them out at their homepage, www.starbucks.com. That's www.starbucks.com. That is their homepage where I pulled this information from. You're probably well aware of who Starbucks is, right? Do you drink their coffee? Do you drink their teas? Maybe you get some of the snacks and food that they offer. Their heritage begins in 1971 along the cobblestone streets of Seattle's historic Pike Place Market. I've never been to Seattle. It was here where Starbucks opened its first store, offering fresh roasted coffee beans, tea, and spices from around the world for our customers to take home. Our name was inspired by the classic tale Moby Dick, evoking the seafaring tradition of the early coffee traders. 10 years later, a young New Yorker named Howard Schultz would walk through these doors and become captivated with Starbucks coffee from his first sip. After joining the company in 1982, a different cobblestone road would lead him to another discovery. It was on a trip to Milan in 1983 that Howard first experienced Italy's coffee houses, and he returned to Seattle inspired to bring the warmth and artistry of its coffee culture to Starbucks. By 1987, we swapped out our brown aprons for green ones and embarked on our next chapter as a coffee house, and the rest, as they say, is history. Now they are all around the world, not just in the United States. And like I said, you probably had some of their coffee, tea, some of the snacks and other food that they provide. Now, the reason we're going to take a look at them, down 2.09% on the day, closed out the day at $93.90. We are talking about Starbucks Corporation, ticker SBUX, out of the consumer discretionary sector. Again, this is one I added into the portfolio 2 to 3 months back here whenever it dipped back under $80. And I was buying it. I've added a little over 100 shares. We'll see my position here in a little bit. And it did run up significantly yesterday, but 2.09% pulled back today. 52-week range as low as $71.55. I was buying in the 70s quite a bit, as high as $107.66. So it is closer to its 52-week high now, at least closer to its 52-week high than its 52-week low. Market cap of $106.407 billion, a beta of 0.94, so they are just slightly less volatile than the overall market. PE ratio, price to earnings, a little elevated for a company like this, in my opinion, $26.30 per share. So that is really in line with what you see for a lot of tech companies, right? But Starbucks has had a lot of growth. I just don't know that if it's going to continue to grow like it has in the past, even with the new CEO announced there. They are having some issues in China, and they do have more competitors in the market now as well. So a high PE, that's what you see for a lot of high-flying tech companies with a lot of growth. again, a company like this that's pretty well built out, been around, again, since the 70s, 80s. There, 87, I think it said. Is the growth there to justify such a high PE? Earnings per share, EPS, $3.57 per share. Earnings date coming up October 31st through November 4th, sometime in that little window. Forward dividend is $2.28 per share per year. They are a quarterly payer. We'll see that here in a little bit, what they pay per share per quarter. Starting yield of 2.38%. Actually, my yield was actually closer to 3% whenever I was buying this. So I've locked in almost a 3% yield on this one. So the yield is lower now than what mine is. Ex-dividend date, August 16th. And they will pay out on the 30th. So you still do have time to buy the company and get their next dividend payout. 1 year target estimate, at least according to Yahoo Finance, $90.84. So they see it may be a little overvalued right now, at least according to Yahoo Finance, where I pulled this information from. We're going to jump over to the right here. We're going to take a look at dividend yield theory. To do that, we look at the 5-year dividend yield average at 2.01%. We compare it to its current 2.38%. I know that says forward annual dividend yield, but it's the current 2.38, same number. And since it is higher than their 5-year average, that speaks to undervaluation. These numbers are inversely correlated. The forward annual dividend yield or the current dividend yield being higher than the 5-year average means they are undervalued. If it was lower than the 5-year average, that would speak to overvaluation. They are inversely correlated. Payout ratio is another one I'd like to look at. We want to make sure our dividends are safe, right? I like under 75%. I know some people might look at 70 or 65, whatever your number is. For me, it's 75% or lower. So it's 62.75%. That's lower than what I'm looking for there. Let's jump down and look at free cash flow. We want growing free cash flow over time, because typically if a company has growing free cash flow, not only are they financially safe, but they're able to pay down their bills, maybe reinvest back into the company, pay out dividends to us, and most importantly, as a dividend growth investor, to me at least, increase those dividends over time. So 2020 here, we can see back September 2020, they were paying they received 114 million in free cash flow. 2021 up to 4.5 billion. 2022 up to 2.5, or a bit of a drop to 2.5 billion. 2023 back up to 3.6 billion. Now they are repurchasing some shares here, so they did in 2020. They did not in 2021, again in 2022. So I would say the decrease in free cash flow here in 2022 from 2021 can be well accounted for in the repurchase of the capital shares here. So that's where some of that free cash flow went. But it doesn't look like it totally accounts for it from 2022 to 2023. You see here it went up to 3.6 billion, but they repurchased a lot less shares. So I'm actually going to call it a bit of a decline from 2022 to 2023 here. Now we're going to jump over to stockanalysis.com. I always recommend more than one source so you can make sure the information you're getting is accurate and up to date. And I will tell you, this is not accurate. 91.89, they did not drop that low. They dropped that low at points in the day, but that's not where they closed out the day. They closed it out in the $93 range. That's why I look at more than one source. Sometimes the information is just, it looks like it froze at some point in the day for whatever reason. Maybe at 11:17 a.m., maybe. But anyways, it closed in the 93 range, and then it is up slightly in the after hours to $93.91. But buy range here, they're saying the 21 analysts that have taken a look at this are calling it in the buy range. You could go to this website and see how many might be calling it a strong sell, hold, buy, or strong buy. Overall ranking is a buy with a low estimate of $80, which would be a 14.77% decrease from where it currently sits. Average estimate of $99 would be a 5.48% increase. And it happened to hit their high of $120 estimate per share. That would be a 27.85% increase. All the while, you could collect that, I think it was 2.3% dividend yield. Now we're going to jump in and look at the statistics here. I like to look at financial efficiency. To do that, we're going to look at return on equity and return on invested capital. And I like 10% or better for both of these metrics. Now, unfortunately, they did not list return on equity. Typically, it is negative for this company because they are reinvesting back in and rebuilding out new stores and that sort of thing constantly. So it's typically in the negative, but they didn't list it this time. Return on invested capital is above the 10% I like at 20.59, but I'm not going to give it a check because they didn't list the ROE. EPS growth, earnings per share growth, I like 5% or better forecasted over the next 5 years. They're sitting at 11.62%, really like that, with nice revenue growth forecasted at 7.7%. Let's jump over their dividend history before we jump back to the screener. All right, so dividend history on this one. It is a quarterly payer. Payout ratio 63.8%. Either way, under 75%. That's well within the range that I'm looking for. Still gives them some room to increase that dividend over time. They are growing their dividend at 7.55%. They've been growing it for 14 years. Buyback yield of 1.03% and positive, and shareholder yield of 3.45%. There now, as I mentioned early on, I am a holder of Starbucks stock. I recently started this position a few months back. It dropped under 80, and that's where I kind of said I'd like to be buying it at. So I built up a 111.288 share count here. Obviously, I'm up significantly in 19.87%. It is no longer within 15% of a 52-week low. Am I holding here, or should I take the 19.87% profit here? I don't know. That does a CEO, which is I think what really made this one pop, does just getting a new CEO account for a 20% raise in the share price? I mean, I need to look at the fundamentals of this one a little bit more. I'd hate to, not sell out. I hate to say that, but it'd be a easy way to make a $1,700 profit here. And then what if it dropped back down into the $70 range? Buy back in. But that's when you start playing a game of is it worth profits? Was this always a long-term hold? And what was my intent originally with this company? I need to go back and think through this one here. And if it was a 30% jump in just a month and a half, 2 months, it probably would be an easier call. But at 19.87%, I've had that type of jump before. So again, quarterly payer. They were paying 49 cents back. What would you do? Let me know. Would you take the 20% jump in here and sell shares out, or would you just continue to hold and ride this? I'm definitely not adding unless it pulls back into my buy range. But right now, I won't be adding. But again, they were paying 2022 49 cents here. Raised it up in 2022, November 53 cents. Raised it up November 2023 up to 57 cents. I'm anticipating a raise here in November as well. So that's another reason I may hold it. I believe they are going to continue to raise the dividend. I do like the company. My wife definitely shops at Starbucks. I'll just leave it at that. All right, onto the screener. Understand the business. That is a check. Growing free cash flow. I'm seeing it's down from last year to this year, or 2022 to 2023. I mean, growing dividend check there. Dividend payout ratio was under 75% in the 60s. Check valuation. Dividend yield theory still says it's potentially undervalued. It is not within 15% of a 52-week low anymore. I did not give them a check here, even though return on invested capital is over 20%, and earnings per share growth is estimated at double digits, so definitely over the 5% I'm looking for. 1, 2, 3, 4, 5. It should still stay in my watch list and my portfolio overall. There's no reason for me to panic on this one, even though it may be a little overvalued. I probably will continue to hold, though it is tempting to lock in a 19, almost 20% gain in less than a couple months. Let me know what you're doing with Starbucks. If you hold it, did you buy it when it was back down in the 70s? Or did you miss out on the drop? Are you thinking of getting into it if it drops again? Let me know. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up. Ring the notification bell. Most importantly, subscribe to the channel. Drop a comment down below. Let me know what you think of the video. Let me know what you think of Starbucks. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a suggestion, a company like Starbucks, go ahead and drop it in the comment section down below. I do have a few on the list right now that I will be getting to over the next week or two. This is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in, and we'll see you in the next one. This is not financial advice. Make sure you do your own research. You can read through the disclaimer, but I am not a financial advisor.